trickle through. Thanks again, everyone, for joining us. Welcome. So we're going to cover this topic right here. Just a quick show of hands. How many of you have run into a situation where your buyer seems like they're going to get the mortgage and qualify and buy the house that you've helped them find and purchase, but for some for one reason or another, they ultimately get rejected for the mortgage. Maybe they don't have enough of a down payment. Maybe other factors. Maybe the stress test is too intense. So just if you've run into that, can you put a 1 in the chat? I just want to get a sense of how widespread this problem is.
Yeah, I would say like the way that I would define that is right now, like we're in a credit contraction. So banks really are the deciding factor when it comes to loans. And banks are very much limiting the number of transactions that can get done. And the big reason for this is they're afraid of the market, right? And so they charge more on rates and they are way more aggressive in their underwriting of borrowers. And so I can even speak from personal experience. I have a handful of clients who will go out, they've sort of underwritten their own thing and said, I can afford this as a payment. And then they go to the bank and get a pre-qualification and it's way lower than what they originally anticipated. And this is a hallmark of a credit contraction, which is why the market gets slow, even when rates are coming down, because the banks are really the ones who are constricting how the market behaves.
Appreciate you jumping right into the market analysis, Daniel, because that's what
It's all I know, man. It's all I know.
Well, that's what we're going to start off with, but just a quick agenda. So Daniel will kick us off with an analysis of the market as to where it's at right now. Lauren will present some solutions to help what I like to call that last mile part of the path to home ownership. Like they're almost there. You just need to give them a boost to get them to the finish line, and then I'll go over how to find, capture, and convert the segment. Primarily through meta ads, but I'll get into that toward the end. Daniel, over to you.
Okay. Yeah. So as David mentioned, I'm going to talk a little bit about sort of what's happening in the market right now, and just share a couple of key data points as to set the stage for how big and important of an opportunity this is. We know that the government acknowledges the importance of first-time homebuyers in their role in the housing market. They just tailored a policy towards them in removing HST on new build homes for first-time homebuyers, as an example. And the market itself is not doing well, right? Like we know this. Anyone who's in the transaction space, we know that we're struggling to get deals done right now in the real estate profession, and it'll take time for the market to recover. I don't even think we're close to sort of turnaround. Sales are moving up, but prices are still moving down. And the sales to new listings ratio would put us in kind of the category where I would say we're in a buyer's market. Or trending towards a buyer's market if we're not technically there. I'm still sort of the opinion that the market moves way faster. So even like sales to new listings ratio or months of inventory, we are very much using historic metrics to analyze what puts us into a buyer's versus seller's market in that category. And I think in this newer fast-paced market where you've got the internet, the flow of information is way quicker. Properties typically sell a lot quicker than they did 20 or 30 years ago when we came up with those metrics. So I think those metrics are a little bit outdated, and what the market we're dealing with in most markets in Canada right now is very much a market that's in favor of buyers. The big challenge and the reason why properties aren't selling is housing is not affordable. In your Toronto and Vancouver of the world, and even in Canada, we're just coming off near record high unaffordability. And so even though basically your first rate cuts, and you can see there's a double peak, and this is a hallmark of kind of recessionary periods in the past in Canada. If you go back to like the 1990s on this chart, you can see there's that double peak. The first peak is when house prices run away and the central bank increases interest rates to try and stop that runaway inflation. And then you see prices come down. That's where you see the first dip, but then prices sort of stop coming down. And because you're now in a higher rate environment and rates are still going up, your housing affordability continues to get worse. And that's where you see the second peak. And then the drop after the second peak is typically after the damage has been done by the central bank and they've sort of successfully won in their war against inflation. they start cutting rates, and then that's where you see the second leg of affordability improving. And you can see there's usually you get the bigger improvement in affordability from that second leg. And we're this will come down a little bit now because we saw obviously Bank of Canada cut rates a little bit today. And that I'm of the opinion that that'll continue to come down as prices and rates continue to fall. But as it stands right now, you hear a lot about these buyers on the sidelines, people who want to buy, but they can't. And the reason that they can't is because housing is unaffordable. And especially in the GTA, you have high cost of living, inflationary pressures, employment, not a lot of wage growth. And so what this causes is people just not being able to get into the market. And in many cases, not even being able to save enough money to qualify for the type of home that they would want to buy or would have to buy if they want to stay in the GTA. And at the same time, you still have the vast majority of Canadians consider their home an investment. And I'm not saying this is something I agree with. I'm just giving you a data point because I personally don't think that someone's home is an investment. I think it's a savings vehicle, and that's really it for most people. Canadians historically not exceptionally good at saving money, not exceptionally good at investing. A house provides a really good vehicle for them to do both of those things. And the majority of people who are renting plan to buy within a couple of years as well. And you have this breakdown where, I mean, this chart on the screen here comes from the Bank of Canada, where the vast majority of buyers in the market are your first time buyers, almost 50%. I think it's about 49%. A lot of people say, oh, investors are controlling the market or investors are pushing the market up. They're not. Investors are 19% of the market. First time buyers are 50% of the market in Canada. And it's not like that they are the super powerful force or anything. It's very simple why this is. First time home buyers don't own houses, so they are net buyers of houses, whereas your repeat home buyers already own a house, and your investors in many cases already own a house, and so they don't need to be buyers of houses. They already do have some exposure to the asset class. The TerraNet recently put out some data on this, basically showing how first-time homebuyers are actually now the largest share of condo purchases at 33%, and the distribution of that is very much in favor towards your 25 to 30-year-olds, so your younger first-time homebuyers. So we're actually skewing lower, at least in the condo asset class. I don't have the headings on these charts, but I think that this one's condos, and then that line would actually move up a little bit to your 30 to 35 for detached. But the overwhelming distribution is, sort of your 25 to 35 age bracket are really making an effort to get back into the housing market in a meaningful way. What are the real problems that these individuals face? Well, they are typically entry level in their career. They don't have a ton of historics on their financials. They don't have assets. In many cases, because they're young, they haven't been saving for a long time, so they don't have a lot of savings as well. So down payment is a bit of a prohibitive factor. So they face the biggest barrier to entry. On top of that, the stress test, OSFI stress test, which we might see getting removed actually within the next year. Like, I don't know if anybody is aware of this, but OSFI is running a side-by-side test where basically they're testing the banks at 450% loan to income, so 4.5x loan to income, at the same time that they're running the stress test. And if it yields similar results, then they might just actually move the stress test over to the banks. And this would actually disproportionately negatively impact your investors, because they would have, like, if like I'm an investor as an example, my portfolio right now is far more than 4.5x my income, because I own a handful of properties and I don't make enough money to service all of those mortgages at 4.5 times my income. But if I'm a first-time home buyer and I only want to own one house, then it would disproportionately positively impact me. And so if OSFI does remove that stress test, there will likely be a lot of things that would move in favor of first-time home buyers in the future. But a lot of first-time home buyers today want to get ahead of impacts like that, right? They don't want to be competing. We hear a lot of people saying, oh, I was waiting for prices to come down 20, 30%. And they are in some markets, and they want to get back in, but they're very much prohibited by the credit environment, their ability to do that. So the last piece that I want to add there is that, like the actual scale of this opportunity, right? So how many home buyers are there that are in this category? And this is where you get the number. I think Lauren's going to go through it a little bit more in detail, but we have like 100,000 potential buyers that they're income limited or down payment limited in their ability to become a first time home buyer. They have the financials ready. We know that most people have decent credit, are current on their taxes, etc. They have an income over 90,000, so above the sort of household median income. There's 1.67 million households in there, 1.34 with credit scores over 650. So these are people who could qualify in a typical credit environment. Back in 2021, they probably could have got a mortgage pretty easily, but maybe they were afraid of house prices or whatever it was. But in many cases, they can't come up with that whatever 10 to 20 to 30% down payment required to get a lender in the current credit environment to give them the money to purchase the property that they want. And so how does this impact us, right? Real estate professionals. I would say that the big thing is, we get somebody into the funnel, they want to buy a house. We're like, okay, cool. Let me hand you off to my mortgage team. I'm sure many of you have more, partners in the mortgage space. You send them off for pre-qualification and it turns out they come back and maybe they, it's not that they're outright rejected, but their budget went from 800 on their own underwriting to, they said, oh, I know that I can personally afford $3,500 a month or whatever, $3,000 a month mortgage payment. But the bank says, no, we're only underwriting you at $2,500 a month or whatever. Because remember, you've got your stress test that now, people are getting stress tested at, whatever, 4% plus your 2%. So they're currently getting stress tested at 6%, unless they can get a cosign from mom and dad or whatever, which is common, and it's an incredibly common thing. CMHC was saying something like 70% of buyers are getting cosigns or gifts for parents. But what about the people who don't have that option, right? Not everybody has rich parents with equity or are credit worthy that are going to improve their credit file, or they just don't want to do it with their parents, right? And so the question here is, how do we activate these people, and what if we could? And that's really what this whole discussion is about today, is how do we activate those buyers who currently can't purchase in today's market because of the credit environment. And that's where I'm going to hand it off to David and Lauren to explain to you sort of the solution that we've been working on for this problem.
Yeah, sounds good. So yeah, you see the majority of Canadians, the data shows that the majority have actually given up on home ownership or are saying that it's only for the rich nowadays because of these challenges and these barriers they face. But then you also see the majority of non-owners still aspiring to buy, but they're just stuck because they don't have enough down payment or they're struggling with the mortgage qualification. So there are different paths that they can take to ownership, that realtors, mortgage brokers, that you can guide them to. A few of them you can consider private or alternative lending, private financing, which allows the buyers to enter the market sooner, and realtors would earn a typical commission when the purchase closes. Or you have vendor take-back mortgages where the seller acts as the lender, and pretty straightforward. Realtors similar when you would earn a commission when the deal closes. Then you have sort of more complicated options. You have co-ownership, or they're all a bit complicated to be honest. And you have co-ownership where people might buy with family or friends or with a company that co-owns and invests into the property with them. These deals could be a bit more complex, but of course the realtors can guide them to the right property and still earn commission on the purchase. And then you have rent to own. So this kind of system where you can choose a home, move in immediately, and start putting money into really a savings account into your home equity. And but in this case, realtors would play a role more similar to rental placement when people start this kind of program rather than home sale. And when you look at these, rent to own is one of the preferred options by buyers, but when you look at the data, only 33% of buyers are actually satisfied with that option because you're really just putting your money into a savings account that doesn't grow and you're not building any equity until the end of the program. So what we're working on over at Key is we've created a new option for home buyers. So it's basically similar to rent to own, but improved where people actually start building equity from day one. So as soon as they move into the home, unlike rent to own, they start building equity and building wealth from their ownership in the property. So equally removes those, or lowers the barriers to entry. So you can start with just 2.5% down, and also you don't have to qualify for a mortgage at the beginning of the 5-year term. So you have a little more time to get ready. If you're self-employed or have a complicated case, it gives you time to build up that stability to take over the mortgage at the end of the term. So this is one option that people really high interest in the GTA that we've been experiencing. A lot of people are really excited to find out about this option that they didn't know existed before, and having realtors guide them to this choice of a new way to actually immediately start building wealth as a homeowner while getting to move in right now, even with minimal savings or mortgage qualification challenges. So similar to rent to own, they buy a home, shop with the realtor. That's where the realtor makes the commission immediately on the sale, and anyone who refers leads to key. We don't take any of the commission from you. Then the client moves in, then they start building equity and saving up for their final ownership, and then they take over at the end and take on the mortgage themselves at the end of a 5-year term. And we leave forever. They're on their own, free and officially full homeowners. So who qualifies for this kind of program? When you were looking at the stats, you can see they have to be able to qualify for a mortgage at the end of the 5 years. So we assess their ability to do so, as well as their ability to, carry the cost of the mortgage, but they only need that 2.5% down. So they can start with much less savings. And when you look at the barriers that people are experiencing, I can't remember, I should have put this in here. I think it was like 60% of people hadn't even started saving for their down payment, of the aspiring buyers out there. So there's a lot of people who may have great income and are ready to own, but they're just struggling with saving the money. I guess, as Dan said, that Canadians aren't good at saving money. Maybe it proves to be true here. And that's the perfect kind of person to enter the Key program and start owning immediately, even with just a small down payment. So that's one new solution that's out there that people are responding very well to. And it's a great channel to help unblock that segment of the market that's just almost there, but being missed by most realtors. I'll hand this over to David to get more into the details of how to find these leads and the effect that they have on lead acquisition for realtors.
Sure. Thanks, Lauren. By the way, we had a comment from Vic Dillon. So he agrees with Dan that B20 stress tests will likely be gone by next year. But he believes that it will, something else will likely replace it. So that's interesting. And that just speaks to the fact that this problem that we're trying to solve isn't going away. And neither is this opportunity. So how do we capture this opportunity? So I'm going to go into how you can tap into this segment and generate really high quality, low cost leads like we are doing at Valery in partnership with Key. So these last mile solutions, turns out they're very effective lead magnets because people are motivated, like Lauren and Daniel mentioned, people are motivated to own. But and a lot of the times they hit most of the check boxes. It's just it's usually the down payment or some other small last step that they need. And so we find that when they're offered a real path forward, they lean into that. And not only do they express interest in the program, but they are willing to share very rich data with us. So income, credit, savings, timeline, what type of home are you looking for? To be honest with you, I was actually surprised that people are giving us this much information for such a low cost per lead. I was actually very surprised. I wasn't expecting that, but that just goes to show that this segment is very motivated. They're really eager to stop renting and to start owning and building their equity. And so with the Key offer, we are finding that according to Lauren's stats, the CPL on their end, as well as with their partners, with their other partners, other brokerages they partner with, is between $3 and $6. For us at Valery, it's $6. But you compare that to the benchmarks, and you can see that this is an offer that is really resonating and doing a great job at generating low cost per lead, low cost leads. And so now the question is how do you target this segment? Where do you find them online? So, you can look to Meta, you can look to Google and YouTube, TikTok, Reddit. I recommend sticking with Meta because it has the lowest cost per lead. Also, they have instant lead forms built in, which makes it easy for you to capture some of that information. Google and YouTube are expensive unless you have a large channel like Daniel does. TikTok has lower ad adoption right now, and Reddit is very niche and hard to crack into. So we recommend Meta, and again, main reason is the cost per lead. So on average, this is not our leads or key leads, but on average, real estate industry leads on Meta, residential real estate costs about $27 per lead. On Google, YouTube, too expensive. Reddit, too expensive. So that's why we like to focus on Meta. The other great thing about Meta is that it's very easy to do retargeting on Meta. So you can, for example, if you have a list of past clients who were declined for the mortgage toward the end of the process, you can obviously you can send an email out to them and let them know about the key solution or other solutions. But the great thing about Facebook Meta ads is that you can actually take that list, upload it into Meta, and retarget those people. And then you could also do things like create a similar audience, or if you have a website, you can target people that went on your website and, let's say, tried out your mortgage calculator, for example. You could target those folks. But one of the challenges with Meta, however, is that they have strict targeting rules or restrictions around the housing industry. So when you have to disclose that you're in the housing industry, otherwise your account might get into trouble. And when you do that, it removes the ability to filter by age. So and it's important for us to be able to target roughly by age, because as Daniel mentioned, that's the segment 25 to 40, really 25 to 35, especially 25 to 35, that really wants to buy, and because they're in that younger segment, they just need a little bit of help to get to the finish line. So the workaround to this is to when you're setting up your Meta ads, turn off the Facebook placements. And reason is that the Facebook audience is typically older, and you want to just keep the Instagram audience on, because the Instagram audience is generally lower. They're more in that 25 to 35, 25 to 40 age bracket. So this is how you get around that. And despite the restrictions, there's still some targeting you can do. You can target based on their interest. The interest that we found is most effective is this one, first-time home buyer grant. So they are interested in a grant or some incentive or some method of assistance with buying their first home. And so these people, we find, are very willing and interested in this offer. In general, first-time buyers are too, but we find that this one leads to better results as measured by the cost per lead. And the sample size across Canada and Ontario is very large. There's plenty of these people, like we said. And I mean, you look at the numbers here, we're looking at 200,000 on Meta. How many of them have 650 credit score plus 100K plus annual income? Probably, who knows, maybe half of them. And that would get us close to that 100K number that we shared earlier. So I already covered this retargeting. It's one of the other nice things about Meta ads. A couple more things you can do with retargeting is you can also target people who like, commented, or messaged your or message you on your Instagram account or on your Facebook account. So for example, if you do a piece of content talking about this problem, share some stats with them, some insights, and then offer them up a few solutions. Obviously, the Instagram or Facebook will keep track of who engaged, who saw it, who clicked like, who commented, and you can go back and target those people with ads as well. Another interesting tool this enables is when you upload videos on Meta ads, you can keep track of who watched them and then target them. So that's something else you could do. So a few tricks here in terms of getting very targeted, but probably the most effective one would be if you have a customer list of people who were declined previously. It's a great way to re-engage them. In terms of messaging that resonates, I would recommend going for a messaging framework with different angles, and address their pain points and offer a clear path forward. So for example, you can focus on the main pain point, which is, saving 20% feels impossible. With just 2.5%, you can start owning. So that is a very, very strong offer, we find. You can also go a little bit more before and after, aspirational. So, stop throwing your money away on rent, start building your own equity today. And you could target this a little bit more to people who do have strong credit and steady income. So by letting them know right off the bat, hey, if you're looking at this ad and you have strong credit and steady income, you're just showing the down payment, you could already qualify. And then there's a couple other angles that you can take as well, and there's a lot more, but these are probably the top 5 that I would recommend tapping into. Just show you some of the creatives that we've done at Valery. We've done this one, for example. And we found but what's interesting is that, so this one here is branded, we have the Valery logo on it, it's in the Valery brand colors. Interestingly, we found that unbranded ads actually perform better. So that's something else you guys can take away, is that the fact that unbranded ads actually perform better on social, especially Instagram. They still have very strong messaging, so it's very clear what the problem is, what the offer is. But because it's unbranded, it seems to do a lot better, probably 50% better in terms of cost per lead. So actually, most of the leads that we're generating off the key offer are through unbranded ads like these. So we're averaging $6 per lead using Meta instant forms with a few of these tactics and the key offer. And if you're a solo real estate agent, perhaps you don't have a big ad budget, but if you can keep your cost per lead this low, $6, $50 per day would get you 8 leads per day of folks who are very interested. They're giving you their all their details, their income, their credit score, when they want to buy, what type of house they want to buy, and you could potentially get 8 of those per day. Whereas other platforms, other offers, $50 might get you 1 or 2 leads. So we find that this the key offer is a great way to maximize your ad spend, especially if you're a smaller brokerage or if you're a solo agent practicing on your own. And that's 240 leads per month with full buyer details, which is amazing. And again, these are people who have high intent and they really want to own now, and they're open to solutions. And the great thing here is that with these people, they might not end up using Key. Maybe you might find that they actually do qualify for a regular mortgage. But if they don't, rather than losing that lead and wasting your ad spend and wasting your time, you have something to fall back on. So I hope that gives you some digital ad tactics that you can use to generate yourself some leads in conjunction with the Key1 offer or other offers. We find vendor take-back mortgages also do very well. They're low cost per lead, like less than $10 per lead, which is almost as good as the key leads. So so if you can offer a solution, whether it's key, whether it's vendor take-back mortgages or other models to folks, sorry, I just had to let someone in. You can leverage these to generate yourself a high volume of high quality leads at a low cost, and also have a solution for your clients who aren't able to get to the finish line. You can now help them get across the finish line. So with that, we'll wrap it up here.
Anyone who would like to, I'll also share in the chat, so grab it before the call ends. I'll just share the email address for Key as well, if anyone would like to just email us questions. I get these emails as well, so you'll be hearing from me if you do so. And then if anyone's interested, also, I know there's some mortgage brokers out there, so anyone who would like to discuss partnering and referring leads to Key, feel free to reach out to us, or talk to Valery. Everyone, all of the agents at Valery are getting Key leads as well as they'd like. And yeah, it's a great forward-thinking brokerage working on modern AI and new programs. So it's, yeah, a good partner. They've been a great partner to us too.
There, everyone. Thanks all for coming this afternoon and making time to learn about some of these solutions. If you want to learn more about the Key program, of course, feel free to scan that QR code or email Lauren with the email she just popped into the chat. If you want to learn more about Valery and what we're doing with AI and the work that we're doing in building what we like to think is a brokerage of the future, feel free to scan that QR code and download our Future Agent Kit. With that said, thanks again, everyone, for coming. Thank you, Lauren. Thank you, Daniel, and enjoy the rest of your afternoon.
Yeah, you too. Thank you, everyone.
Thank you.